10 companies now hold 41% of the entire S&P 500. The last time concentration looked like this, the market crashed. In the first half of 2025, artificial intelligence infrastructure accounted for 92% of all United States economic growth. Strip away the data centers, and the world's largest economy barely grew at all. Nearly everything now rides on one technology. Bank of America calls them the AI Big Ten. Nvidia, Microsoft, Alphabet, Amazon, Meta, Apple, Tesla, Broadcom, Micron, and AMD. Their share of the index matches technology's share at the peak of the dot-com bubble, right before $6 trillion evaporated. Wall Street veterans are split. Jeremy Grantham calls this the most expensive stock market in history and predicts a major correction. Michael Burry, the investor who called the 2008 housing crash, is publicly betting the bubble pops soon. But the Federal Reserve chair says this time is different because these companies earn real revenue from real customers. Both sides are looking at the same numbers. What they disagree on is where the money funding this boom actually comes from. Because when you trace those dollars, they move in a circle. And once you see the circle, you cannot unsee it. Start with the scale. Amazon, Alphabet, Microsoft, and Meta are on course to spend $725 billion on AI infrastructure. That splurge is projected to shrink their combined free cash flow to $4 billion in a single quarter. The post-pandemic average was $45 billion. The richest software companies on Earth are starting to resemble heavy industry. Meta alone raised its capital spending forecast to as much as $145 billion for 2026. OpenAI committed $1.4 trillion over 8 years to build new data centers. One company, $1.4 trillion. JP Morgan estimates the full build-out needs over $6 trillion by 2030 for data centers, energy, and chips. Here is the detail that worries the bankers. A growing share of that money is borrowed, not earned. Much of the debt sits in off-balance sheet vehicles, kept at arm's length from the cash-rich tech giants. So a $6 trillion build-out, financed increasingly by debt, resting on demand that has not fully arrived yet. Which raises the question nobody building these data centers wants to answer out loud. If demand disappoints, who eats the losses? Now, the circle. In 2025, Nvidia announced plans to invest $100 billion into OpenAI. OpenAI then committed $300 billion to Oracle for cloud computing, one of the largest contracts in history. And Oracle turned around and bought tens of billions of dollars in chips from Nvidia to deliver that capacity. Follow the cash. It leaves Nvidia's balance sheet as an investment and returns to its income statement as revenue. Analysts estimate more than $800 billion now moves through arrangements like this, circling a small group of companies. Critics call it vendor financing, a supplier bankrolling its own customer. The dot-com era ran the same playbook. Back then, equipment makers like Cisco, Lucent, and Nortel lent billions to carriers, who built networks nobody ended up needing. Supporters answer that building AI is genuinely expensive. Chips are scarce, and these deals simply lock in supply. Maybe. But at the center of the loop sits OpenAI, projected to lose $14 billion in 2026 alone, nearly triple its prior year losses, while promising $100 billion in revenue by 2029. The circle holds only if that promise does. Here is the strangest part of the whole story. The customers, the businesses actually buying AI, report almost nothing changing. A National Bureau of Economic Research study found 90% of firms saw no impact from AI on productivity. Another analysis found 95% of enterprise AI deployments produced no measurable effect on profit and loss. Economists call it the productivity paradox. 40 years ago, computers spread through every office while measured output barely moved for years. Yet in the same survey, executives still projected AI would lift productivity. The spending runs on faith that the gains arrive later. So capital expenditure is surging while free cash flow weakens, and the customers funding it all report no returns yet. Analysts describe these as classic warning signs: private valuations outrunning durable profits, and financing loops multiplying quietly in the background. And here is the uncomfortable truth the optimists rarely say out loud. A technology can change the world and still be a bubble. The most dangerous manias form around technologies that genuinely work. Investors see the future coming, then rush too far ahead of it. The internet was real too, and it still erased $6 trillion of wealth. So what actually happens if this one pops? Analysts have mapped two scenarios. The first is an equity crash, a repeat of the dot-com unwind. In that history, the Nasdaq fell nearly 80% from peak to trough, and the S&P 500 fell 50%. $6 trillion of equity value vanished, equal to 60% of national output at the time. Unemployment climbed to 6.3% and took 47 months to recover. The index needed 7 years to claw back. The second scenario is worse, because this cycle carries something the dot-com era mostly lacked: leverage. If AI capital spending is debt-financed, a downturn becomes a wave of credit defaults, concentrated, lumpy, and contagious. That is the answer to who eats the losses. Not just tech shareholders, lenders, pension funds, and the credit markets underneath everything. Which is why the referees have entered the game. The Bank of England is formally monitoring AI as a financial stability risk. The European Central Bank ordered banks to file AI risk plans by October. The Bank for International Settlements warned of a burst. When the referees start preparing for a crash, you pay attention. And yet, the other side of this argument has real receipts. Start with the Federal Reserve. Chair Jerome Powell argues AI companies generate real revenue, unlike the profitless dot-coms of 1999. JP Morgan ran a 5-factor bubble diagnostic and concluded the rally links to actual enterprise revenue, not pure speculation. Unlike the late 90s, today's market gains come from earnings growth, not from investors simply paying higher multiples for hope. The IPO count tells the same story. Roughly 100 offerings expected this year, near the long-run average. 1999 saw 400, and profitability is arriving somewhere. Anthropic reportedly expects a profitable quarter in 2026, with quarterly revenue above $10 billion. So the honest answer is uncomfortable. The technology is real, some of the revenue is real, and the financing is still circular. Every previous mania looked obvious only afterward. In the middle, smart people on both sides had numbers, and the numbers disagreed. The $6 trillion bet is not really on AI. It is on timing, on demand, arriving before the debt comes due. Watch the free cash flow, watch the credit spreads, and watch whether customers ever start reporting gains. Those 3 lines decide everything. And that missing productivity, the 90% who feel nothing, That paradox has its own strange history. That story is next. If this changed how you see the AI boom, subscribe to the Ledger Wire. We follow the money every